The strangest thing about modern money is this: a lot of it begins as someone else's debt. Not as gold, not as printed cash, not as a pile of bills sitting inside a giant vault. Debt. A person signs a loan. A bank says yes, and suddenly new money appears in a bank account. That sounds impossible because most of us imagine banks in a very simple way. Someone deposits $1,000. The bank keeps that money safe. Then another person walks in and asks for a loan, and the bank lends out some of the money that was already sitting there. Simple, clean, easy to picture. But here is the strange part. That picture is not really how modern banking works. Because banks are not just places where money is stored, they are also places where money is created. And the hidden move begins the moment a bank approves a loan. Imagine this. Anna walks into a bank and deposits $1,000. She thinks her money is now safely sitting somewhere inside the bank. Maybe not literally in a box with her name on it, but close enough. Then Ben walks into the same bank. Ben wants to buy a house. The house costs $300,000, so he asks the bank for a mortgage. Now pause for a second. Anna deposited $1,000. Ben wants $300,000. So where does the $300,000 come from? Most people imagine the bank opening a vault, taking money from depositors, moving old money from one place to another. But that is the vault myth. The bank does not need to find $300,000 in cash sitting in the back room. When the bank approves Ben's mortgage, it creates two things at the same time. First, it creates a loan. Ben now owes the bank $300,000. Second, it creates a deposit. Ben now has $300,000 available in his bank account. That new deposit is money Ben can use. He can send it to the seller of the house. The seller can receive it. The seller can move it to another bank. The seller can spend it, save it, or use it to pay someone else. And to everyone in the system, that money is real. This is the part most people miss. The bank did not simply move money from Anna to Ben. The bank created new bank money by creating new debt. The loan created the deposit. And once that deposit exists, it can move through the economy like any other money in a bank account. This does not mean the bank pressed a magic button and became rich. It does not mean the bank can create free money for itself without consequences. And it does not mean the system has no rules, but it does mean something surprising. Most of the money we use every day is not physical cash. It is numbers inside bank accounts, and many of those numbers were born when a bank made a loan. Think about what happens next. Ben uses the loan to buy a house. The seller receives the money. Now the seller's bank account goes up. The seller may use part of that money to buy a car. The car dealer uses it to pay employees. The employees use their salaries to buy groceries. The grocery store pays suppliers. The suppliers pay drivers. The drivers pay rent. One loan becomes someone's sale. Someone's sale becomes someone's income. Someone's income becomes someone else's spending. The money starts moving. And because it moves, it feels normal. Nobody stops at the grocery store and asks, was this money created by a mortgage? Nobody receives a salary and asks, did this money begin as somebody else's debt? But somewhere behind the scenes, a promise was made. A borrower promised to repay. A bank recorded that promise. And a new deposit entered the system. That is the hidden move. Modern money is not only printed, it is also borrowed into existence. Now, this raises an obvious question. If banks can create money when they make loans, why don't they create infinite money? Why not approve every loan? Why not type $1 million into everyone's account? This is where the machine gets interesting, because banks can create money through loans, but they cannot do it without limits. A bank is not just asking, can we create this deposit? It is asking, will this person pay us back? Because the new money comes with a debt attached to it. If Ben cannot repay his mortgage, the bank has a problem. The loan that looked valuable becomes risky. The bank expected future payments. It expected interest. It expected the house to be worth something. But if too many people stop paying, the machine starts to shake. This is why banks care so much about credit scores, income, collateral, interest rates, and risk. Not because they are just being difficult, but because every loan is a bet on the future, a bet that someone will earn money later, a bet that they will keep paying, a bet that the promise will hold. And this is where money and trust become almost the same thing. The borrower trusts the bank to create the deposit. The seller trusts that deposit as payment. The worker trusts the salary. The store trusts the card transaction. The bank trusts the borrower. And the system trusts that most promises will be kept. But the story does not end there. When Ben pays back the loan, something strange happens. The debt gets smaller. And the money that was created by that debt can shrink too. When new loans are created faster than old loans are repaid, more bank money can enter the economy. When loans are repaid, defaulted on, or not created at all, the machine can slow down. This is why credit matters so much. It is not just about people borrowing, it is about how much new money is entering the system. A growing business may need a loan to hire workers. A family may need a mortgage to buy a home. A shop may need credit to buy inventory. When banks are willing to lend, money can move faster. Projects begin, homes are bought. Businesses expand, salaries are paid. But when banks get scared, the opposite can happen. They approve fewer loans. People spend less. Businesses delay plans, money moves more slowly. The same machine that creates money can also stop creating it. And when trust disappears, the machine can break. That is why banking is so powerful. A bank is not just a building with glass doors and a vault. It sits at one of the most important points in the economy. Between the present and the future. Between a promise and a payment. Between someone's debt and someone else's money. And this changes how you see your own bank account. That balance on your screen is not a pile of cash waiting in a drawer. It is a claim. A promise from the bank that you can use that money when you need it. You can transfer it, spend it, withdraw it, pay with it. But most of the time, it never becomes paper money at all. It stays digital. It moves from account to account, from buyer to seller, from employer to worker, from borrower to business. Numbers moving through trust. This is why the old picture of banking is too simple. The bank is not only a vault. The bank is also a machine that turns promises into spending power, a machine that turns debt into deposits, a machine that helps create the money we use every day. But it only works because people keep paying, because sellers keep accepting, because banks keep trusting, because regulators keep limiting, because the public keeps believing that the numbers on the screen will still work tomorrow. So the next time you see a bank building, do not imagine only a vault. Imagine a factory of promises. Someone walks in needing money for a house, a car, a business, or a new beginning. The bank looks at the future and decides whether to believe it. If the answer is no, nothing happens. But if the answer is yes, a loan is born, a deposit appears, and new money begins to move. That is the hidden move. Banks do not just store money, they create it when they create debt. And modern money is not just something we hold, it is something we borrow, spend, trust, repay, and sometimes destroy. If you want more simple stories about the hidden moves behind money, business, technology, and power, subscribe to The Hidden Move.